So I'm having some real difficulties implementing my SIPP plan at the moment. Let me show you some details. So the plan's not complicated. I want to put basically 60% of my savings into an overnight fund, 30% into some large ETFs, 3% into some individual stocks, and leave myself 2% in cash. But as you can see at the moment, I've got far too much in the overnight fund. I've got 74% rather than 60%, and I've also got 8% in cash rather than 2%. So what's the problem? Well, it's a tricky, really. It relates to the timing of the transfer of funds from the overnight fund, from a cash position into the large ETFs. And I'll show you what I mean. So here is a chart inside my free trade account that shows the performance of my investments over the last 6 months. Up over 8 grand, so really happy there. And you can see there at the bottom of the screen that I've got over £94,000 in the overnight return. Now, an overnight return gives a fairly solid 5.2% return. Doesn't go up or down much, it just returns pretty much the same amount and relates to how banks lend money to each other overnight. As interest rates change, that will change a little, but it will generally be a fairly straight line whenever you see a chart of the overnight fund. So in that respect, it's low risk, but also has low returns. I do want to keep 60% of my stock in there, but not 74%. So you can see here that the overnight return is actually 73.4%, 8.6% in cash, and then the rest split between some large ETFs. So the challenge for me is to move some of the money from the overnight return and my cash position into large ETFs. The particular large ETF that is a preference for me that I really want to move my funds into is the FTSE All World share there. You can see I've only got 3.8% of my investments there at the moment, and I want to get that up to around 15% really, with the other 15% sitting in my global high yield and my Euro dividend aristocrats. So my issue is one of timing. And I'll show you what I mean. Here's a chart of the All World FTSE. This is a 6-month chart, and you can see that it's gone up 15% in the last 6 months alone. Now, historically, the FTSE All World will generally return about 9% over 12 months. So if you think it's done 15% over the last 6 months, am I confident that it will do another 15% over the next 6 months? Or will it revert back and drop so that the average over the last 12 months is 9%? Well, nobody actually knows. And every bit of research I've done and every string of my intelligence tells me it doesn't matter, just buy in. However, that's difficult. The cautious part of me is saying, don't transfer the whole 15% at once. Buy in £5,000 a week. And then at least if the market does start to drop, then I will be buying shares at lower prices as the market drops. But as I said, I know this is not a sensible thing to do. It's just really hard when the market is so high to move such a large amount of your SIPP from a safe investment such as the overnight into something which, by looking at a graph, feels to me like it's about to drop. So that's my quandary really, and I probably will go against logic and buy in a small amount each week, £5,000 each week, until I've transferred and I've rebalanced my accounts. So that's the quandary I had today. So the charts we've been looking at here have been in my free trade accounts. I have put a link to free trade in the description to this video in case you're interested.
So if you've heard my outro, then thanks for listening. And if you haven't, then here's probably the most important bit of investing advice you'll hear on YouTube. Don't buy or sell shares in a company based on what someone on YouTube tells you. The big Wall Street analysts have large teams of professionals with access to vast amounts of data on every single listed firm. There are no YouTube gurus who know better than them. Use YouTube to find interesting bits of information on companies that you may otherwise miss. And when you find something interesting, do your own digging and see what the analysts in the big firms are saying. Never invest more than you can afford to lose, and don't expect to get rich quick. If you are interested in my background, I come from 16 years in risk management with PwC and Deloitte. I've never been on a trading floor in my life, but if I had, it wouldn't give me the edge on the big firms because they have big teams and masses of information. So don't look for a guru with an edge. Look for information on companies you're interested in. And if you're looking to invest a large amount of money, don't put it on individual stocks. Choose an index fund. The ALL World Index is a representation of all the stocks in the world. And if one company goes broke, then the index won't even move. Whereas if you've only invested in that one company, then you may have just lost your pension. Keep it fun, keep it affordable, and subscribe to keep getting my updates. Thanks.